Over the last month, I compared today's UK economic data with the conditions that existed before every major modern crash, including the 1970s oil crisis, the early 1990s recession, and the 2008 financial crisis. I wasn't searching for headlines or worst-case scenarios, but for recurring patterns. What emerged was unsettling, not because everything looks identical, but because too many of the same warning signals are now appearing at the same time. Debt is rising, while growth slows, household finances are stretched, property prices are detached from income, credit is tightening quietly, and the central bank is constrained by conflicting priorities. We are not at a crash point yet, but we are far closer than most people realize. What makes this more dangerous is that most of the British public doesn't see it. People feel pressure from higher bills and higher mortgage payments, but they still believe the overall system is stable. History shows that this belief is usually strongest shortly before stability breaks. That's why understanding the difference between a difficult economy and a fragile one matters. Crashes don't come out of nowhere. They follow sequences, and if you know what to look for, you can see the stress building long before the headlines change. One of the most consistent pre-crash signals is the relationship between debt and economic growth. Before every major downturn, total debt across households, corporations, government, and the financial system grows faster than the economy itself. This creates a widening gap where liabilities expand without a matching increase in productive output. That pattern was visible before the 1970s crisis, before the early 1990s recession, and most dramatically before 2008. Today, total UK debt sits at roughly 4 to 4.5 times GDP, depending on how it's measured. Household debt remains elevated, corporate borrowing is high, government debt exceeds 100% of GDP, and the financial sector is still heavily leveraged. At the same time, underlying economic growth is weak, hovering around 1% or less. Debt continues to expand faster than the economy supporting it, which is one of the strongest warning signs seen before previous crashes. Household financial stress is another key signal. Before downturns, families are pushed close to their limits, with a growing share of income going toward debt payments and essential costs. In the late 1980s, rising mortgage costs left households exposed when interest rates spiked, leading to a surge in repossessions. Before 2008, household debt reached extreme levels relative to income, trapping families when property prices fell. Today, household debt remains high, but the more immediate issue is the sharp rise in mortgage payments for those who have refinanced in the past 2 years. Many households have seen housing costs rise to nearly a fifth of their income, while unsecured borrowing has increased and defaults have begun to rise. Millions of households now spend over 40% of their income on housing alone, leaving little room to absorb shocks such as job loss or unexpected expenses. Historically, this is exactly the level of stress that allows small disruptions to escalate into systemic problems. Property markets also tend to signal trouble before crashes, particularly when prices detach from income. In the run-up to the early 1990s crash, UK house prices peaked at around 5 times average earnings. Before 2008, they reached roughly 7 times. Both levels were considered extreme at the time. Today, the national price-to-income ratio is around 8 times earnings, and in London and the South East it exceeds 10 times. These are the highest levels ever recorded in the UK. At such ratios, the average earner cannot buy without taking on substantial leverage, which means the entire market depends on interest rates remaining relatively low and credit staying widely available. If either condition changes meaningfully, prices are forced to adjust, and adjustments from these levels are rarely smooth. Another recurring feature before major crashes is tightening credit. This process is often gradual at first and easy to overlook. Banks become more cautious, lending standards tighten, and borrowers who could access credit months earlier find themselves excluded. Before the early 1990s downturn, banks reduced loan-to-value ratios and income multiples, which quickly drained demand from the housing market. Before 2008, stresses in credit markets turned a slowdown into a full-scale collapse. Today, mortgage approvals remain well below pre-pandemic levels, deposit requirements are higher, income multiples are lower, and first-time buyers are increasingly locked out. This is not yet a complete credit freeze, but the direction is clear. and history shows that once credit contraction gains momentum, it amplifies every existing weakness in the system. Central bank constraints are another familiar warning sign. Before past crashes, policymakers were often trapped between conflicting objectives. In the early 1990s, high interest rates were needed to defend the currency and control inflation, even as they crushed the housing market. Before 2008, rates were kept too low for too long, inflating bubbles that later collapsed. Today, the Bank of England faces a similar dilemma. Inflation remains above target, limiting how quickly rates can be cut, while higher rates are placing increasing strain on mortgages, property markets, and highly leveraged businesses. Cutting too soon risks reigniting inflation, while holding rates high for too long risks financial instability. This constraint significantly reduces the ability to prevent a downturn once it begins, which is a recurring feature in pre-crash environments. Finally, there is the gap between economic reality and public perception. Before major crashes, conditions deteriorate faster than people expect. Life feels harder, but the system itself still feels safe. Risk is underestimated, and warnings are dismissed as pessimism. That gap exists today. While stress is visible across households and businesses, confidence in overall stability remains relatively high. Historically, that confidence tends to disappear very quickly once a trigger hits, and that is the critical point. The economy is not in a crash, but the conditions that make crashes possible are firmly in place. When enough of these signals align, it often takes only a modest shock to push the system from strain into crisis. Understanding that difference is what separates preparation from being caught completely off guard. The most dangerous phase before any major crash is the period of complacency, when fundamentals are deteriorating, but the public still believes the system is broadly stable. History shows that when reality finally catches up to complacency, the adjustment is often sudden and violent. Before 2008, even as late as mid-2007, the dominant belief was that problems were limited to a handful of subprime lenders in the United States. Very few people understood that the entire global financial system was already on the edge of collapse. The gap between perception and reality was enormous, and when that gap closed, panic spread almost instantly. That same gap exists today. Most people recognize that things are difficult, but they still believe they are stable. They are not tracking debt levels that continue to rise faster than growth. They are not watching stress build quietly in the property market. They do not fully grasp how stretched household finances have become, or how limited central bank tools now are compared with the past. There is a large and growing disconnect between how vulnerable the system actually is and how vulnerable it is perceived to be. Historically, when that gap becomes too wide, it represents one of the strongest pre-crash signals. That does not mean a crash is inevitable. There are important differences between today and previous crises, and those differences matter. One of the most significant is the condition of the banking system itself. In 2008, banks were extraordinarily over-leveraged, with leverage ratios of 30 or even 40 to 1. Small losses were enough to wipe out capital entirely, forcing collapses and bailouts. Today, banks are far better capitalized. Regulatory reforms require them to hold significantly more capital. Leverage is constrained, and stress testing forces banks to demonstrate resilience under severe scenarios. This does not mean banks are immune to losses, but it does mean that a housing downturn would be far less likely to destroy bank balance sheets immediately, in the way it did during the global financial crisis. Another difference lies in household savings. In the run-up to 2008, savings rates were extremely low. Households had little financial buffer, so income shocks translated quickly into defaults. Today, household savings are higher than they were before the pandemic, though well below the artificial peak seen during lockdowns. On aggregate, this provides some cushion. However, this is where averages become misleading. Savings are very unevenly distributed. Higher-income households have accumulated most of the buffers, while lower and middle-income households, which are also the most exposed to rising housing costs, often have very little. As a result, headline savings figures mask significant vulnerability where stress is most likely to appear first. Employment is another area where the picture differs from previous crashes. Historically, unemployment often began rising before downturns became obvious, triggering defaults and accelerating broader problems. Today, unemployment remains relatively low, around 4 to 5%, and employment has shown resilience despite weak growth. However, the quality and security of employment are weaker than the headline numbers suggest. 0-hours contracts, involuntary part-time work, and gig economy jobs with limited protection have become more common. This means that while job losses have not yet surged, income security is fragile, which can still amplify financial stress without showing up immediately in unemployment statistics. Policy capacity also looks very different from past crises. In previous downturns, central banks and governments had significant room to respond. Interest rates could be cut aggressively, bond buying programs could be expanded, and large fiscal stimulus packages could be deployed. In 2008, these tools were used at unprecedented scale and helped prevent complete collapse. Today, policy space is far more constrained. Interest rates are already in the 4 to 5% range, leaving limited room for cuts before hitting zero again. Central bank balance sheets remain large from earlier rounds of quantitative easing, making further expansion politically and economically contentious. Fiscal policy is also constrained by high public debt levels. This does not reduce the risk of a crash. If anything, it increases the risk that any downturn would be harder to stabilize because the response would be weaker and slower. What ultimately turns vulnerability into a crisis is a trigger. One plausible trigger is a mortgage default cascade. Over the next 12 to 18 months, a large number of households will continue to refinance onto much higher mortgage rates. For many, monthly payments will rise sharply. A portion will cope by cutting spending, drawing on savings, or using short-term credit. But if even a modest share of households genuinely cannot sustain the new payments, defaults begin to rise. Banks initially attempt mitigation through payment holidays and term extensions, but if stress persists, repossessions follow. A significant increase in forced sales adds supply to the market, pushing prices lower. Falling prices create negative equity for recent buyers, reducing mobility and confidence. Demand weakens, lending. Standards tighten further, and price declines accelerate. Once this feedback loop starts, it can sustain itself without any external shock. Another potential trigger is a deeper commercial property downturn. Office and retail properties continue to face structural pressure from remote work and e-commerce. If valuations fall sharply from peak levels, loans secured against those properties become under-collateralized. Owners struggle to refinance, rental income fails to cover debt service, and defaults increase. Losses of this kind would not necessarily collapse the banking system, but they would likely cause banks to retreat sharply from property lending. That retreat would spill into residential mortgages, construction finance, and development lending. With credit drying up, activity slows, employment weakens, and stress spreads across the economy. A third trigger could come from outside the UK entirely. Global financial stress does not respect borders. A renewed episode of US banking instability, European sovereign debt concerns, a deeper Chinese property collapse, or major emerging market defaults could all trigger a global shift away from risk. When risk appetite falls, capital flows to perceived safe assets. For a country running persistent current account deficits and reliant on foreign capital, that shift can be painful. Sterling weakness would raise import prices, complicate inflation control, and further constrain domestic policy choices, amplifying existing stresses at home. The critical point is that none of these scenarios requires dramatic new imbalances to emerge. The vulnerabilities are already in place. What determines the outcome is whether a trigger pushes the system past a threshold where feedback loops take over. That is why the gap between complacency and reality matters so much. When people underestimate risk, adjustments tend to be faster and more disorderly. Understanding these dynamics does not mean predicting a crash tomorrow. It means recognizing that the margin for error is thin, and that when shocks arrive in an already fragile system, the consequences can escalate far more quickly than most expect. If inflation were to re-accelerate towards 6 or 7%, the central bank would face an extremely difficult choice. To defend the currency and regain control of prices, interest rates would need to rise further, but higher rates would sharply increase stress on the property market and on highly leveraged households. If policymakers chose to prioritize currency stability, rates could be pushed towards 6 or 7%. Anyone on variable rate mortgages or refinancing would see payments rise again, defaults would accelerate, and property prices would fall more rapidly. What begins as an external shock would quickly turn into a domestic crisis. The probability of this scenario is moderate. The global financial system currently has multiple points of stress, and the likelihood that something breaks elsewhere and spills into the UK cannot be dismissed. Another possible trigger is a political or policy shock that undermines confidence in UK economic management. This could come from unfunded spending commitments, abrupt tax changes, or political instability that raises doubts about policy continuity. In such a scenario, bond markets would react quickly. Gilt yields could spike sharply, for example, with 10-year yields rising from around 4.5% to 6% within weeks. That would immediately worsen government finances as debt servicing costs rise and deficits widen. Higher deficits would further alarm markets, pushing yields higher still. Sterling would weaken, adding inflationary pressure. The central bank would then be forced into a painful choice between defending the currency with higher interest rates or intervening in bond markets with emergency purchases. Raising rates would intensify pressure on households and the property market, while bond purchases would risk damaging credibility and reigniting inflation. A version of this dynamic was seen in September 2022, when market confidence collapsed following a policy shock and was only stabilized by rapid reversal. If reversal were not possible or not believed, the result could be a sustained crisis. The probability of this scenario is low to moderate, but recent history shows it is not theoretical. Crashes are rarely caused by a single event. They occur when multiple problems interact and amplify each other. A realistic cascade might begin quietly. Mortgage defaults start to rise as refinancing at higher rates continues, and property prices slip by a few percent, which initially feels manageable. As months pass, stress in the commercial property sector worsens, and a major property company defaults. Banks absorb losses and tighten lending standards further. Mortgage approvals fall sharply from already depressed levels, reducing demand. Property prices decline further, pushing recent buyers into negative equity. Media coverage intensifies, confidence weakens, and households become more cautious. An external shock then hits, triggering global risk aversion. Sterling falls, imported inflation rises, and expectations of rate cuts disappear. Interest rates remain higher for longer than markets anticipated. Defaults accelerate, banks report larger losses, and smaller lenders retreat from the market. Credit availability contracts further, unemployment begins to rise, and stress spreads into the wider economy. By the time this becomes widely recognized as a crisis, property prices may be down 20% or more, credit is tight, and policymakers are in emergency mode. This is how crashes actually unfold, not as a single dramatic moment, but as a sequence where each weakness reinforces the next. The most dangerous phase of this process is the early stage, when problems appear serious but manageable. In the first 6 months, price falls look modest, defaults are contained, and policymakers reassure markets. By the time it is clear to everyone that the system is in crisis, the window to protect yourself effectively has largely closed. That is why preparation matters before the situation becomes obvious. To decide how to respond, a simple framework helps. The first question is personal exposure. If you are highly leveraged in property, have a small deposit, face refinancing soon, work in a sector vulnerable to downturns, and have limited savings, a crash would be severely damaging to your finances. Even with a moderate probability, protective action is justified. If you have reasonable equity, a fixed-rate mortgage, some savings, and a relatively resilient income, a downturn would be painful but survivable, and preparation rather than drastic action makes sense. If you rent, own outright, or have substantial diversified savings and secure income, a crash would be disruptive but not financially devastating, and you may even be positioned to take advantage of opportunities. The second question is the time horizon. If you need access to your money within 1 to 3 years, you cannot afford large losses, even if they eventually recover, and a more conservative stance is appropriate. If your horizon is 3 to 10 years, you can tolerate volatility but should still manage downside risk. If your horizon is longer than 10 years, particularly if you are early in your career, you may be able to ride out severe downturns and benefit from lower asset prices if you have liquidity. The third question is psychological tolerance for uncertainty. Some people cope well with volatility, while others experience significant stress. If uncertainty causes anxiety, prioritizing stability over potential returns may be the right choice. If you can tolerate moderate uncertainty, a balanced approach works best. If you are comfortable with volatility and disciplined in your decision-making, you can maintain exposure and potentially deploy capital during periods of stress. Based on these three factors, responses differ. Those with high exposure, short horizons, and low tolerance for uncertainty need maximum protection through larger emergency buffers, careful debt management, and reduced vulnerability to income shocks. Those with moderate exposure and horizons should focus on sensible buffers, diversification, and flexibility. Those with low exposure, long horizons, and high tolerance can remain largely positioned for the long term while staying alert to opportunities. Finally, there are concrete indicators that reveal whether vulnerability is turning into a crisis. Mortgage approvals falling sharply and remaining low indicate collapsing demand. Sustained declines in major house price indices signal a trend rather than noise. Weakening retail sales volumes show consumer demand is fading. Rising credit delinquencies point to escalating financial stress. A sharp and sustained rise in gilt yield signals bond market concern. Significant sterling weakness reflects loss of confidence. Bank share prices trading well below book value suggest markets expect serious losses. If several of these indicators deteriorate simultaneously, the shift from preparation to active protection becomes necessary. Is a major crash inevitable? No. Vulnerability can persist for long periods without tipping into crisis. But the alignment of pre-crash patterns is strong, policy flexibility is limited, and multiple plausible triggers exist. The difference between being prepared and being caught off guard is whether you are watching the right indicators and understanding what they are telling you. The patterns are visible. The triggers are real. The only uncertainty is timing. Staying informed is what gives you an advantage.